Welcome to the Psychology of Trading course. In this course, you'll learn all about the decision-making process of trading, simply, quickly, and interactively. Remember that you're free to watch each individual lesson as often as you'd like. So now, if you're ready, let's get started. Fear gets in the way of successful trading. That's why understanding and controlling your fears is so important. How do you stop your fears from controlling your trading? The answer is by developing a trading plan. Your plan should set your trading goals and identify the price levels and strategies you'll focus on. If you don't yet feel like you know enough to plan in this way, then you might want to focus on practice trading or seek out more traders' education before trading for real. Success as a trader requires overcoming your fears and developing the confidence to learn from your mistakes. For long-term success, you'll need to believe in your ability to make more money than you lose. That makes it easier for you to continue to place trades, even after a string of losing positions. Most traders know what it feels like to hold on to a trade too long and see significant profits evaporate as a result. When this happens, it's often the trader's greed that's to blame. Greed changes the way you think and act and can cause you to make mistakes in the market which can cost you dearly. A lot of new traders imagine that it's possible to earn returns of 100 or 1,000 times their initial investments from just a few days of trading. Add a high leverage rate into the mix and you have a surefire recipe for disaster, courtesy of greed. The decision to invest in the markets should be based on rational analysis. Trading isn't gambling, and it should never be treated like it. Remember that there are a lot of opportunities in the markets, but you'll only be able to exploit them if you learn to control emotions like greed. Most traders focus on deciding what and when to trade, but pay too little attention to the question of how to invest. After all, when you think you've spotted an opportunity, should you go all in? Actually, the answer is no. Don't risk your account in a single trade. It's the classic mistake of an inexperienced trader, and it means letting your greed control you. Always remember that the market can go against you. As a trader, your position management strategy is crucial for successful trading. You may not be able to control the markets, but you can control how you invest and the amount of risk which you take. Your money management strategy should answer these two key questions. How much money should I risk on any single trade? What size of trades should I be making? As a trader, your first goal should be to preserve your capital. If you can stay in the market long enough to achieve some big wins, it should cover the costs of your losing trades and deliver you some returns on your investment. Good money management can help you make this happen. Most experienced traders never risk more than 2% of their trading capital on any single trade. With a $10,000 account, that means your maximum potential loss should be $200 on a trade. Risking more than $1 per pip on a $10,000 account is considered unwise by many traders. So the right number of pips you should be willing to lose in this trade before the stop loss is hit is also 200 pips. It's no secret that you can't control the direction of the market or the extent of its swings and movements. But there is one way in which every trader can achieve real control over their trading, and that's through money management. Money management is a set of rules and guidelines to help you keep risk at a level where you're comfortable. Effective money management asks, then answers these three key questions. What should my risk-reward ratio be? What is the right amount of risk for me to accept per trade? And how much risk should I take across my account? These questions sound simple, but getting them right is the key to your success as a trader. With the right money management strategy in place, you can be wrong 50% of the time when you trade and still profit overall. The risk-reward ratio helps traders determine the level of risk in a trade. It shows how much a trader is risking versus the potential reward they can make if the trade proves a success. How do you calculate the risk-reward ratio? It's simple. The stop loss displays your risk and the Take Profit displays your potential reward. So if on a specific trade your stop loss is set at $100 and your take profit is set at $200, then the risk-reward ratio is 100 to 200 or 1 to 2. The larger your risk-reward ratio, the more easily you'll be able to absorb losses through time. An acceptable risk-reward ratio for beginning traders is 1 to 3. Any number below 1 to 2 is too risky, and the trade should be avoided. Congratulations! You have successfully completed the Psychology of Trading course. You're now ready to start exploring the markets yourself. Stay tuned for advanced lessons and courses. Good luck, and welcome to the world of trading.